Good afternoon, everyone. In this video, we're going to go through the trades that set up for April 20th, 2020. There were trades that set up in two different markets for us. One was the Russell 2000, in which we had an entry to go long using our aggressive volatility box models with an entry at the cloud looking for a target at the cyan line for a target. And we did get that target plus some really nice follow through for a total of $795 on that one trade in which we risked just 550. So that was a fairly manageable trade in terms of risk on the contracts. The second trade was in crude, in which that risk was much greater, right? That risk in crude was 1420 compared to 550 off of the same two trades. You can see the P&L was bigger, but it also cost a lot more to get there. So that's the transparency behind the crude trade, where you may very well have chosen to use the QM contracts, which may have been a smarter decision in terms of trade management and risk management. Now, again, in crude, we were buying the dip using our doomsday aggressive models, which is the ones that molded to price action in that first hour. And we'll go through this entire process, but really those were the two markets that gave us entries. Outside of that, the S&P, the Nasdaq, and the Dow did have breaches, which we'll also talk about. And we had a market in natural gas, which really just blew through all of our models, which doesn't happen all that often. So I'd like to call that out as well. So a few different things we'll talk about in this video, but I think all of them serve a purpose. So let's start with crude oil, and on our charts here we have our aggressive volatility box to start off, and we'll take you through the entire process in which you draw a line in that first hour and you check to see whether or not the volatility box lines were breached. Now these blue bubbles come up letting you know that, hey, we've breached the aggressive volatility box, and these are just training assistant bubbles to help you get started when you're first joining the volatility box family, right? But really what you should be able to tell here very clearly is price broke outside of our aggressive volatility box. So let's switch on over to a model that's slightly more conservative. Our next aggressive model is our doomsday aggressive model. So let's go ahead and load that in. Now with our doomsday aggressive model, what you should notice is that does a much better job of containing price action. In fact, we go to the very edge of our clouds before price starts to reverse, right? So at this point, this isn't the confirmation in which you know to use the doomsday. At this point, our test is still open in which we have this line of equality almost, in which we're checking to see which happens first. Are we going to break outside of our volatility box clouds or hit that same distance on the opposite side, letting us know that, hey, the sellers do have control from what we consider to be our volatility box levels. Now we start to see that, hey, price has the follow through that we were looking for, letting us know that it's okay to continue to use the aggressive volatility box models, and we are seeing the follow through that we would expect. And so at this point, since we are on our slightly more conservative models, any breaches of our cyan line are fair game, along with a confirmation in our edge signal letting us know that, hey, the market has truly oversold or overbought, whichever way you're looking at. So now we're looking at entries off of our doomsday model, and we get that entry in the 11 to 12 a.m. Pacific hour. So price breaches our volatility box line right here. We get the edge signal confirmation, and at this point, the trade is now valid. Our entry is at the cyan line, stop outside of the volatility box, and we're looking for a move of at least the same amount on the opposite side, which is 71 cents in this particular trade, right? And so that 71 cents is the move that we're looking at. We get that move almost right away for that first contract, and the second contract is $1.21 from our entry, and that's using the target line on the opposite side, which we get in this nice burst up higher towards the beginning of that final hour of the market open. And so that's the trade in crude oil, but you can see how we used our different volatility box models to adapt to the volatility that we were seeing in the crude markets, waiting for that confirmation once we got that confirmation that, hey, these models are being respected, and only then looking to enter into a trade. Now let's repeat the same exercise, but on the Russell futures, which should look a little bit different. On the Russell, that first hour was telling us that, hey, we could use our aggressive volatility box. And you should also notice no blue bubbles going off here because there's no reason to have a need to switch models just yet. So now we're continuing to wait for breaches of the cyan line on either side. And that happens in that 11 to 12 p.m. Pacific hour, in which price breaches our volatility box lines, and then our trading assistant again goes off to tell us, hey, you should now wait for an edge signal. So if we turn this off just so you can see the edge signal in itself, so we'll turn that off. You should then be able to see that we did in fact have an edge signal after the breach right here before we had the follow through in the opposite direction, and price then did give you an opportunity to enter at the clouds looking for that scalp. First target is our cyan line, which gives you an opportunity to take your contracts off in a place that's normally our entry and cut our risk in half. Stop is still outside of the volatility box, and then the second contract target is at the other side. And that's how you can still use the aggressive volatility box models to play when the moves are in your favor and cut the risk in half, essentially, right? Because if you look at the same setup in the S&P, you'll notice that we did breach our cyan line, but we didn't get that same follow through, but instead price really just chopped sideways to then coming down. You didn't stop outside of the volatility box, but assuming you didn't want to have that afternoon risk, you essentially had to take this trade off for a loss of right around 9 points instead of what would have been originally your point of entry at the clouds in these high volatility conditions since you're on the aggressive models. And then finally, we said we take a look at natural gas. And so if we do load up natural gas here, if we take a look at that same first hour test here, so all we want to check is what does price action look like in that 6 a.m. to 7 a.m. Pacific hour. And we want to see the models in which these clouds really are able to encompass price action. So these are our most aggressive models, really just doing a very poor job of accommodating price action today, right? So now let's move up in stairs. So our next aggressive models are the Doomsday Aggressive. Same thing, price is breaching outside of the volatility box clouds. We move on to our conservative. Should notice something very similar, right? Price still outside of the clouds. And now we move on to our Doomsday Conservative, and even that is going outside of our volatility box clouds. And that's where we had our signs that, hey, we're seeing more volatility than usual in natural gas with this breakout side, and it's best to focus on other markets in which we are getting more controlled volatility, where we're still able to use even our most aggressive volatility models. All right, so I hope this video and this walkthrough of the different markets in which we had trades, as well as some places in which we just had breaches, along with the natural gas market where we had extreme volatility, gives you an idea of how the volatility box lets you know where you should focus in the first hour, along with giving you levels in which you can start to take actionable trades with rules and a trade plan that helps you to stay on the right side of the marketplace. Take care, everyone. Good luck trading the rest of this week, and we'll see you in the next update.